So how's it calculated? And this is a very important section. Touched on it a couple of times, but it's going to be a combination of income and assets, both as parents and students. And again, this gets a little dicey, and sometimes people get a little confused. So I'm going to try to go slow here, but don't be surprised if you have to rewatch this module a couple of times. So parent and student income, no matter what, we're always going to be looking at the adjusted gross income, and we're going to take the adjusted gross income, and I'll show you an actual sample tax return in the next slide so you can see what line we're talking about. But the adjusted gross income is going to be from your previous year's tax return. And I know it's very odd, but they actually did that and changed it up a couple years ago to make it easier. And some of you might be thinking, well, Mike, how does that make it easier? Well, in the past, what we would do would be we would estimate what our income would be. Let's say we're filling out the applications in October, November, December, January, before people had their taxes done for that tax year. We would fill out all the financial aid applications with estimates. And then once you did your taxes, you have to go back and update everything. It was a complete mess. So what they said was, look, this is silly. We're doing double the information, double the work. Let's just base it off of the previous year's tax return. Now, as an example, so if your son or daughter was going to be a freshman in college in fall 2019, for the financial aid applications their senior year, you'd submitted your 2017 tax information. Now, this does become problematic for some families when their financial situation, especially if they might have lost a job or just had a life-changing event or what have you. 2 years is a long time, so even though it's 2018, 2019, as far as when their son or daughter is going to be going to school, you're given the 2017 tax information. It might be drastically different as far as what your current situation really reflects. And we'll talk about that when we talk about how to appeal a financial aid award, because that's really going to be your only chance to highlight a discrepancy in your income based on a 2-year-old tax return. But just know, parent and student income is going to be based on your adjusted gross income, and it's always going to be the previous year's tax return. Now, as far as assets are concerned, we're going to value your non-retirement assets, and it's going to be valued on the day you complete the application. And this is a key point to make here. It's that there's no look-back periods. It's not previous years like the tax return. It's literally whenever you sit down and complete the FAFSA form or the CSS profile, which we'll talk about, wherever your assets lie on that day is the way you fill out the forms, okay? And I'll get into this a little bit later on when we talk about some examples of how you can reduce your expected family contribution, including sheltering assets, and how you can do that all the way up to the point where you fill out the applications, because, again, it's a snapshot of the day you complete the application. So very big distinction between the two. And I'll get into non-retirement assets. What does that mean, the definition? I'm just setting the stage here in this early slide about income and assets. But again, a big distinction. Income is previous years tax information. As far as assets, it's a snapshot literally on the day you complete the application. Doesn't matter where the assets were the day before, wherever they are lying, if you will, on the day you're filling out the application is how you're going to capture that information. So the other key aspect to this is assets, okay? So similar to the income allowance for students, you also have what's called the Asset Protection Allowance, or APA for short, and that's for parents. So what they say is, generally speaking, and it's a chart based on age, but $15,000, in my opinion, is a nice number to just go off of. Basically, the first $15,000 parents have in non-retirement accounts, and I'll get into the definitions in a second, but non-retirement accounts and non-retirement assets, the first $15,000, as far as their value, we won't hold against you. Anything above that amount, we're going to start taking a percentage of and factoring in and adding to that expected family contribution number that we started with as far as looking at your income. Just like we took a percentage of your income, we're going to take a percentage of your assets. and they basically break it down into two broad categories: retirement assets and non-retirement assets. And I'm going to explain this in a slide or two, so just bear with me. But just like income, well, they're going to look at parent assets and they're going to look at student assets. And again, the rule of thumb: never, never, never have any assets held in the student's name, because similar to the income that they're going to penalize you 50% on, well, they're going to penalize you 20% when computing your expected family contribution when it comes to assets, which again is more strict than the way they look at parent assets, which I'll get to in a second. So, quick example. Let's say you have a UGMA, which is a Uniform Gift to Minors account. All right? And it's valued at $30,000. Well, that's considered a student asset, not a parent asset. So they're going to take 20% of that, and they're going to add $6,000 to your expected family contribution. Well, Mike, what about the $15,000 APA? Well, the asset protection allowance for parents, not students. So they're going to take $1 of the $30,000 and apply $20,000 to it. They're not going to subtract out $15,000. If that was a parental asset, they would, but it's not. It's a student asset. Okay, and I'll expand on this in a couple of minutes, but here's just showing you again why the rule of thumb: never have any assets in the student's name, never have any income in the student's name above the income allowance amount, and really never have any assets at all in the student's name. Now, some people say, Mike, I started a custodial savings account for my son or daughter years ago. As long as your name's attached to it as a parent, your Social Security's on that account, that's fine. That's not going to be viewed as a student asset. Okay? The big one, which I'll talk about later on, is this UGMA, or also a UTMA, the Uniform Transfer to Minors Act. These were big investment strategies in the 80s. And this is really, in my opinion, really the only one that's really applicable as far as a student asset is concerned. I'll talk about 529 plans in a second and why those are parental assets, not student assets. But you see, the 20% is a pretty strict penalty, especially when we get into the percentage that they're going to use for parents. Now, is debt considered? Generally speaking, personal and consumer debt is not factored in when computing your expected family contribution. Okay, they're not going to care how much credit card debt you have, car loans, things of that nature. The debt on investments such as real estate, such as mortgages, will be counted. Okay, so they will count that as far as equity is concerned, but personal consumer debt's not going to be factored in, unfortunately. Now, this is a very key point. Is home equity considered on the FAFSA? Is that an asset? And not for your primary residence, but they will factor in vacation homes or investment properties or any other home that you might have in your personal name beyond your primary residence, minus the debt like we just talked about. Also, if you have multiple owners of, let's say, an investment property and you own a percentage of a share of it, you only report your percent. So let's say you, your brother, your sister, you all, got an investment property. You might inherit it from your parents if they passed away, and you own 33%. Well, you're not going to value that at 100% and report that on the financial aid applications. You're going to value that at 33%. Okay, now we'll get into this when we're doing this tutorial on the applications. But as far as trying to come up with your expected family contribution, just know your primary residence will not factor in on the FAFSA form, the home equity. It doesn't matter if it's a $10 million house. It will not affect you. It's a very key point. And I'll explain a little bit later as far as the difference between the FAFSA and the CSS profile, because this is a big one.